Good morning, Forefront family. Happy Wednesday. Quick personal story. Yesterday was a big day in our house. My son lost his first tooth. And of course, my wife and I had a conversation about what the tooth fairy leaves. Apparently, there has been inflation since I was a child. I was in favor of a quarter. We settled on $5, which seems a little high, but right? That's happy wife, happy life. More importantly, happy children, happy life, right? So my son lost his first tooth. He is very excited. But into my normal daily email. So yesterday, 189,791 people is a total number of people recovered from COVID-19, according to the COVID Tracking Project. So for the second day in a row, positivity was below 10%. But the actual number of new cases, it hasn't fallen as much as we're hoping. So yesterday we had about 22,000 positive tests. Now, again, we've averaged about 30,000 a day, so 22,000 it's coming down still. And while we performed 260,000 tests yesterday, the death toll yesterday was artificially high. So you're gonna see that number come out. It was artificially high due to a data reconciliation out of Pennsylvania, which caused them to report an additional 554 deaths. So Monday was a volatile day, like I spoke about yesterday. We saw the markets fall in the open, but then they ended higher. Yesterday proved to be similar, but different. We started the day with markets jumping, but as the day went on, and then specifically after a White House report that President Trump was considering dismantling the coronavirus task force, whatever that is, that kind of paired the gains. The Dow ended up for the day just about 0.5%, while the S&P and NASDAQ gained about 1% for the day yesterday. So over the past few weeks, I've heard a variation of the same question over and over, both asked to me, and honestly, I heard it in the grocery store the other day. It's what prompted me to make this video. And the question is always, but seriously, what's up with the stock market? And I think what's happening is most people can't understand how the level of most major indexes right now don't seem to align, with the real economic damage that we are seeing on the ground. So this is the largest real economic shock we have felt in modern history. And, indices are only off a little over 11%, 12% in some cases. The best way I can describe what's up with the stock market is in a few key points. So first, the Federal Reserve has intervened in a massive way with both fiscal stimulus and monetary policy changes, which in many ways have been impressive. This isn't going to save every company, far from it. There's going to be bankruptcies, but keep this in mind. The top economist at Goldman Sachs wrote yesterday that disposable personal income is likely to register a slight positive growth for this year. We have unemployment going into the teens, but the belief is the government is going to provide individuals with enough support that it will actually register an increase in personal disposable income. Whether we agree with the increase in benefits the government are providing, what it will serve to do is hold up the consumer, which is a huge part of the economy. Second, we can sum up this divergence in the stock market and the real economy in one word: technology. Tech companies are already an overwhelmingly large part of major indexes, right? Indexes are market cap weighted or price weighted. So the bigger the company, the more it affects the index. So they are a sector and a business that is not nearly as impacted from coronavirus. In fact, their models in many cases are thriving at this time. So think Amazon, think Microsoft. Don't let this skew your thinking though. If you look at the other sectors such as energy and retail, airlines, hotels, the carnage is massive, with some losses exceeding 60%. Finally, optimism that although the numbers in the US aren't dropping as quickly as we would all like, the data is showing an overall improvement in the country. And we're seeing that being reflected with many states working through the process of opening up their economies. In addition to focusing on the efforts of 38 states that are reopening, investors are also watching a great trend in the housing market. Mortgage applications to purchase a home have risen for the third week in a row. And as the national average of interest rates on a 30-year mortgage have fallen to 3.4%. And refinance applications are down slightly from last week. They're up over 200% from a year ago this time. And that's when rates were about 1% higher, according to a report by CNBC. So this is a positive sign for the housing market, specifically when you consider the fact that many states are still under stay-at-home directives. So there are goods in the economy. I wanted to address that with you. I hope you all have a wonderful Wednesday. I look forward to seeing and speaking to everybody soon. And don't forget to use the book your appointment link on my website to schedule a quarterly review. At the moment, we're doing them, with video via Zoom, but schedule your review. I miss seeing everybody, and I hope to see you all soon. Have a great day.